Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets, and analyse the issues impacting the Kiwi economy. Let's get into it. Kia ora and welcome back to Markets, Mystics and Mayhem. This episode we're going to be talking about the New Zealand labour market. We've had some data come out recently and it's just showing that the labour market in New Zealand just continues to cool, where jobs are actually being cut now. We're seeing people leave the labour market. So we'll cover a bit about that. We'll cover, rising unemployment, what that means for the Reserve Bank. And keeping with the name of the show, we're going to be doing mystics and we're going to be looking forward and see where we think unemployment is headed over the next wee while. But I guess first off, why don't we start with the numbers? Sabrina, why don't you paint us a picture? The data was for the September quarter, so why don't you just rattle off some of the key numbers that we typically look at?
Yeah, let's get the numbers over and done with so we can really get into the sort of deep and heavy stuff. So unemployment rate rose to 4.8%. Now that's an almost 4-year high. Employment growth was down 0.5% over the quarter. And here's the kicker. Employment growth was down 0.4% over the year. And that's the first annual decline in over a decade. At the same time, we saw the labour force participation rate fall to 71.2%. And the number of people not in the labour force increased by 60K, so 60,000. And then looking over at wages, we did see wages were up 0.6% over the quarter, but annually they actually slowed to 3.3%.
Yeah, okay, cool. So those are the numbers, that's the background. I guess when I hear those numbers, the one that sticks out to me the most is unemployment rate, which was at 4.8%. We were expecting, and markets were expecting it to be closer to 5%. What do you make of that?
Yeah, so it's kind of interesting because none of us were sort of at our desk last week when this data came out. We were all sort of busy on the road, which is super unusual for us economists to not be at our desk when a data release comes out.
Yeah, we usually had to lock up and actually get to see the numbers before it comes out.
Yeah, and so I had to just sort of pull up my phone and do the old Stats NZ website and sort of refresh. And yeah, I saw 4.8 is that headline rate that comes up on the screen for unemployment. And I guess at first I thought, oh, that's not as sort of weak as we were expecting. But then sort of my second thought was, okay, something must be happening to the participation rate.
Yeah, so that's really the reason why we didn't see unemployment rate rise to 5%. It was solely down to the participation rate falling by much more than we expected. So a lot more people are leaving the labour market, and that's kind of tempering the rise in unemployment. And I guess we can go through the reasons why people are leaving the labour market. People are leaving, going back to school, going into sort of early retirement. We're obviously hearing about these voluntary redundancies. So all of that is playing into the mix.
And that's all happening because actually, the labour market is weakening. There are less opportunities, less jobs out there. It's harder to get jobs these days, unlike what we saw sort of that post-COVID cost of living crisis era, right?
Yeah, during COVID, just to tell you how tight our labour market was, we had a lot of the sort of marginal groups coming into the market. So a lot of young people had come into the labour market, filling those COVID sort of shortages in jobs. So a lot of young people came into the labour market sort of at the expense of education. We're seeing that unwind now. So our labour force participation rate rose to a record high of 72.4%. Now we're seeing it come down and just sort of normalizing. A lot of young people are making up that sort of 60,000 increase in the people outside the labour force. So a lot of them are going back to university, going back to study.
Yeah. And so going back to the participation rate, if we hadn't sort of seen that fall in the participation rate, we probably would have seen a sort of bigger increase in the unemployment rate. But we're also talking about how we actually saw the participation rate sort of peak over the sort of post-COVID period, hit a record high of about 72.4%. Are we just sort of starting to see a bit of an unwind from that?
Yeah, I think so. It's just we saw a very tight labour market during that COVID period where demand for workers is very high, but at the same time, there were no workers around because we had closed our borders and, the sort of domestic talent pool was very small. So our labour force was very tight during that time, but now we are seeing that unwind with the unemployment rate falling. But on top of that, our economy is very weak and it's started to weigh on the labour market.
Yeah, so we're seeing a bit of an unwind from the tightness in the labour market during the COVID period, but now it's also turning into sort of an unwind, or I guess an increase of recessionary impacts on the labour market. And can't forget that the recession that we're in right now is actually by RBNZ design, and we're sort of starting to see that come up through the job cuts and employment contractions.
Yeah, exactly. The labour market, it often lags the broader economic cycle. And as you said, we've been in recession for the last sort of 2 years. And now that softness in the economy is weighing on the labour market. So yes, we didn't see the unemployment rate rise as high, but the labour market underlyingly is still just as weak because we saw employment actually contracted 0.5% over the quarter and 0.4% over the year. Again, as you said, it's the first decline in over a decade. That is, businesses are closing down, unemployment is rising, and that is that impact of the recession on the labour market as the Reserve Bank had engineered.
Yeah, and at the same time, even though unemployment wasn't as weak as we thought it would be, wages actually slowed down a bit quicker than we thought, right?
Yeah, so it's going back down. That sort of quarterly move of wages growing at about 0.6, 0.5% on a quarterly basis, that's becoming more and more consistent with levels of overall inflation running at sort of 2%, which is the Reserve Bank's target. So we're kind of getting to that much cooler phase in terms of wage growth, which from the Reserve Bank's perspective is exactly what they want to see, because domestic inflation has been very strong and it's still very, persistent, but you need this weaker wages to get inflation back down to 2% and sustained at 2%.
Yeah, definitely. And I think it's interesting, probably something we should point out is we talked about the labour market sort of lagging the broader economy and how we're just sort of starting to see the unemployment rate rise as a result of the recession that we're in. So we're not done yet, are we? We're going to see more.
Yeah, this is just the beginning for job cuts. As we were saying, the rise in unemployment we've seen right now is because employment growth wasn't keeping pace with a growth in our labour supply. Now, with employment going backwards, that's what's going to drive unemployment rate higher. So we'll probably see the unemployment rate settle to around 5.5% from its low of 3.2%. So that's quite a big swing. So we're just expecting more of the softness to continue.
We know employment contracted 0.5% over this quarter and 0.4% over the year. But are there any particular sectors that are really sort of seeing these sort of wind downs come out of?
We know the recession has been particularly tough on industries like retail and construction, and that's where most of the job losses have stemmed from.
Yeah, so retail, because consumer spending has been down and pretty much destroyed. And then construction, I guess the housing market's just been pretty weak, right?
Yeah, the housing market's been very weak. Financial conditions have been very tight. So there's no appetite to build, in this time.
Plus, investor appetite is just down with all the sort of policy restrictions that they've been faced with as well, right?
Yeah, absolutely. So all that's weighing on the housing market. And when there's no activity happening there's no incentive to build. And so construction activity has been very weak. And with that, a lot of the employment losses have come from the construction sector.
When we hear of the unemployment rate going up, it's never good news, really. But we know that we have to reach a more sustainable sort of place than where we were back in sort of post-COVID times. But when do we really sort of start to panic and say, actually, okay, unemployment's going really high now. So we've got about 5.5% sort of penciled in. When do we sort of start, hitting alarm bells?
I think, maybe you're in that sort of 6 to 7 to 8% range. That's more reminiscent of the GFC, and that was a much, weaker time for the labour market. So if we saw unemployment rate rising to about that, that's when it will be, not good news for the economy, and just tells you that the economy is in a much worse state and would require, much faster reductions in the cash rate from the Reserve Bank. But we're not there yet. We're still picking for a sort of 5.5% unemployment rate peak.
Yeah. We're not there yet, but that kind of just shows that we do need the Reserve Bank to be mindful. We know that the labour market does lag, and we need them to be sort of keeping this in their sort of foremind as they're sort of looking at rate cuts. I think we're still calling for another sort of 50 this year. But really what we need is just to return to neutral, right? For interest rates to go back to neutral in a place where they're no longer sort of restraining demand and restraining activity, but just heading back to that neutral spot.
Yeah, with inflation now back within the Reserve Bank's band, their focus, monetary policy just does not need to be as restrictive as it is. They can stay ahead of any further unnecessary weakness in the labour market and the broader economy. So yeah, they just need to, reduce the cash rate further, even though these latest numbers had come in slightly below what they were expecting. That doesn't really change how they'll be thinking, looking at the numbers. It's still showing you that the labour market is soft and will continue to weaken. All the drivers are the same. So I think it just tells you that the Reserve Bank needs to continue with, easing monetary policy.
Yeah. So we've had a bit of downish news talking about unemployment. It's not the nicest subject. Is there any good news that we can sort of leave off on?
I think, one thing from the wages picture is that it's still running above, consumer price inflation. So we're entering this period where real incomes will be growing. You're not going to feel it just yet. Won't be a meaningful improvement until maybe next year. But we're sort of entering this period, exiting the cost of living crisis, and entering this period where real incomes are starting to grow.
Well, not to be a negative Nancy, but to conclude, we're probably still going to see a bit more to come on the unemployment rate, rising up a bit into next year. And people are doing it tough out there. The labour market is loosening so much that we are seeing people exiting or being forced to the exits. And, whether that's going back to school, skilling up, or just retiring early. But I think what this needs to come back to, and what we sort of covered, is that this is, a sign to the Reserve Bank that, they can and they should be and they will be lowering interest rates to get back to that neutral setting, so that we can sort of go back to an era of not being so constrained and restricted, and, hopefully see unemployment, start to come off its peak and settle back down. Cool. Well, that's all we've got time for today. Thanks for listening. And if you liked what you heard or saw today, please make sure to subscribe or follow us along for more.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.